How's everybody doing? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, we're going to be focusing on the regulatory war on fintech. I have been following some articles in Bank Director that have been posted over the last couple of months, and these are the first two parts in a four-part series that the authors have put out. Now, this episode is going to be part one on this. We're going to cover these first two articles here, and then I will bring you part two kind of whenever those articles come out. I'm not sure how long it's going to take. Hopefully it doesn't take that long, but just to give a quick background to this context of what we're going to talk about here is that basically you had the failure of a fintech company called Synapse Financial Technologies, and that failure led to a massive problem with a number of banks, the key one being Evolve Bank and Trust, where customers basically lost access or they can't find about $85 million in customer funds. And now we're basically dealing with the fallout of all that. What is the regulatory response to this? And so that's what these first two articles are about here today. So let's bring these up and let's take a look at the first one. This first one here is titled "The Regulatory War on Fintech. Federal Agencies' Skepticism of Fintech Partnerships Poses a Threat to Innovation in the Banking Industry." And this was written by Lawrence Kaplan and Jason Schaefer. And it goes on here to say, basically, innovation is a hallmark of the modern U.S. and global banking system. Credit and debit cards, automated teller machines, online and mobile banking, each of these products and services now commonplace were novel technologies of their day. To bring each of these products and services to market, banks, innovators, investors, and regulators had to work together to identify and address the new risks each technological development posed. Unfortunately, the experience of most novel technologists and banks today is that regulators, both the leadership in Washington and the frontline examiners, are skeptical of anything new or disruptive. The skepticism and fear of the unknown regarding technology comes at a cost for U.S. households, businesses, and the competitiveness of the overall economy. In the U.S., banks have several significant advantages to non-banks, including cheap funding via deposits and access to liquidity through the Federal Reserve's discount window. In return, banks are subject to a variety of federal and state oversight. Often, banks face challenges innovating because they rely upon legacy technologies and older core operating systems. Now, I want you to keep all this in mind for a second, because I'm going to come back to this in a minute when we talk about open. I want to make a little comment on open banking here at the end. So here you are with regulators fretting about their fintech relationships and how banks are managing those relationships, and basically, and basically sitting here saying that, hey, banks face these challenges and innovations. And yet at the same time, you have regulators saying, oh, well, you guys need to do open banking, and you guys need to do, you need to adopt this whole open banking system and make your customers' data available to anybody and everybody that wants to get it. It's just the dichotomy here is almost crazy. Okay, anyway. So now we continue on here with enter fintechs. So unencumbered by old technology and energized by fresh thinking, fintechs can act nimbly to develop new solutions to old problems. In addition, the operations of fintechs are frequently free from scrutiny by federal and state regulators, at least during their development phase. Fintechs often need banks to access to the payment system, and only banks can provide certain services such as deposit products. However, the potential benefits of these symbiotic relationships cannot be recognized without the regulators. Regulators are by their nature risk averse, among other things. Avoid losses to the Federal Deposit Insurance Corp's insurance fund. Recent events show that regulators' hesitancy about bank fintech partnerships are not unfounded. However, in our view, regulators too often fail to appreciate that there are real costs to the roadblocks they put up. Now, here's what's interesting. Recent events show that regulators' hesitancy about bank fintech partnerships are not unfounded. Again, I give you the example of open banking. The only way that banks could achieve this open banking rule by the CFPB is if they, guess what, have to work with fintechs and preferred fintechs in order to make that happen. But on the one hand, it's totally fine. On the other hand, it's, oh, this is a big problem. We got to watch this. So, but I digress anyway. So such costs include the growth of activity outside the regulatory perimeter, so-called shadow banking. that bank regulators often do not have the authority to supervise. As the shadow banking market continues to grow, questions arise as to whether an event in that market could result in a systemic event with broader implications for financial stability. In addition, fintechs let smaller banks compete with bigger banks. Smaller banks often have fewer resources than their larger peers to innovate internally, and partnering with fintechs allows smaller banks to offer competitive products and services. If regulators limit the ability of smaller banks to partner with fintechs, it should come as no surprise that larger banks that are investing in innovation will increase their already outsized market share both on the lending and the deposit side. The resulting increase in concentration in certain of the largest banks would have the unintended consequence of increasing financial stability risks and competitive concerns. In recent years, the pendulum has swung rather aggressively between regulators open to innovation and those who are highly skeptical of it. The financial system and the public would benefit from a more honest debate about the costs and benefits of innovation. The regulators, the regulated, and the fintechs would be wise to recognize that there are three parties in this partnership, and all of them would be better off if each maintained an open mind and an open door. And then it goes on to say this is the first article in a four-part series. In part two, we will discuss recent regulatory developments that highlight regulators' resistance to innovation. Part three will address guidance for banks and fintechs that seek to continue to innovate. And part four will review the post-election changes in Washington and the likely implications for the future of innovation in banking. Now, I would take it a step further. Like, they go on to say that, hey, there's three people in this relationship and all three need to kind of work together to, make this all work and make things happen. I would say it's a little worse than that at the moment because you have this Dr. Jekyll, Mr. Hyde. You have these multiple personalities almost from the regulators. On the one hand, it's like, hey, if you're going to, we need to put forth open banking and all these other crazy things. And that's totally fine. But on the other hand, it's like, hey, if you just want to partner up with a fintech to make payments a little bit easier for somebody because you don't want to pay for the cost of the Zelle system, let's say, that's a problem. That's a huge problem. We need to really, you need to over monitor that fintech. And that's without even saying the word partnership. Okay, I did a couple episodes where I talked about basically the word partnership. I don't like the word partnership. I mean, again, here you see third party relationships, the vendors that banks hire, like that. That's really what they are. I mean, when you hire a fintech, when you're a bank and you hire a fintech to do something, that's a third party relationship. You're hiring a vendor to do something for you. They're not a partner. You're not partnering with them. Again, partnership means that you share in the upside and the downside. It means that you're both bringing equity to this partnership and that you're sharing in the fruits of the labor. That's not what's happening. You're hiring a vendor to perform a task for you. But anyway, I digress. I digress again. Okay, so here's the second article here. Regulators take a more hands-on approach to bank fintech relationships. Bank must take notice of several ways that federal banking agencies are rethinking third-party dealings. So then they talk about the recap there. While the advent of middleware providers altered the direct banking as a service BaaS model relationship between banks and fintechs, the May collapse of Synapse Technologies highlighted various model deficiencies after consumers lost access to funds, drawing the ire of regulators and lawmakers. Though regulatory and enforcement actions by the federal banking agencies in recent years have signaled ongoing concern over BaaS models, Synapse's collapse served as a wake-up call to banks that continued to believe that fintech engagement can be conducted as a turnkey activity, resulting in a flow of easy fee income. Federal agencies' response to the Synapse collapse, regulatory and supervisory guidance addressing risks posed by third parties that arrange the provision of deposit products and services, new enforcement actions against BaaS-focused banks that lacked appropriate oversight and significant rulemakings have effectively halted most banks' laissez-faire approach to these relationships. Now, a new framework for bank fintech relationships has emerged that requires substantial bank involvement. In July, federal banking regulators issued a joint statement highlighting potential risks in bank fintech relationships, along with a request for information, RFI, on these arrangements, benefits, risks, and risk management practices. The statement and RFI demonstrated the agency's heightened focus on bank fintech arrangements, in particular, banks' oversight and risk management. While neither issuance imposed new regulatory requirements, they signaled that further guidance on risk management practices would be forthcoming and that enforcement actions against banks failing to meet regulatory expectations may continue. The agencies have relied on enforcement actions to target banks that failed to manage risk associated with fintech partnerships. Those actions imposed significant operational restrictions and, in some cases, required business model changes. Frequent areas of focus included corporate governance, third-party risk management, and anti-money laundering issues. Each of these issues is critical to a bank's oversight of fintech partnerships and serves as a roadmap of areas to focus on for all banks engaging in the BAAS model. Through their actions, federal regulators sent two clear messages. Number one, regulators do not believe that they need new prescriptive rules to ensure banks maintain appropriate oversight on the operations of their fintech counterparts. Okay. And number two, regulators are willing to act when bank fintech partnerships do not satisfy their expectations. So now we have three things here. We have rulemaking, we have broker deposits, and we have custodial account record keeping. So Rulemakings are a slower process due to notice and comment requirements under the Administrative Procedure Act. Nonetheless, following Synapse, the FDIC has proposed significant regulations that, if adopted, would significantly impact bank fintech relationships. So it's kind of interesting there. So on the one hand, we just had the two messages. So the first one was regulators do not believe that they need new prescriptive rules. However, right here in the rulemaking, it says that the FDIC has proposed significant regulation that, if adopted, would significantly impact fintech relationship. So next we go on to broker deposits. So in July, the FDIC proposed a rule to revise its broker deposit framework, which was overhauled in 2020. The proposal seeks to roll back the more reflexive approach adopted in 2020. It would eliminate key exemptions to the classification of deposits as brokered, which banks and their fintech partners have relied on, causing banks to pay higher deposit insurance premiums and disrupting the economics of fintech relationships. Now, here's what I find kind of weird about this, and some people might disagree with me on this. I feel like you have a confluence of things here. Like, I don't think that broker deposits necessarily needs to be the focus of this conversation over the larger, I will say, the conversation around fintechs and managing that fintech relationship. I think those are kind of two separate things that need to be evaluated differently. I really don't think how interjecting broker deposits into this whole conversation, while they may have there may be a link there in the chain at a certain point, but I don't think that's the primary focus here. I think what we really want to be focusing on is when banks work with fintechs, how can banks be sure that the fintechs don't fail? And if the fintech does fail, what does the bank do in that situation? But anyway, okay. And then we get down to custodial account record keeping. So in September, the FDIC proposed a rule that would apply to almost any bank fintech arrangement that uses custodial deposit accounts to provide customers with transactional features known as for benefit of FBO accounts. These accounts are prevalent in bank fintech partnerships and allow a bank to hold one omnibus account for fintech, which then keeps the records of the beneficial owners whose funds are held in the bank. If adopted, the rule would require a bank to do the following. Number one, maintain records that show the beneficial owners of those deposits, including the balance attributable to each beneficial owner, end user, fintech customer, etc., and the ownership category in which the deposited funds are held. Okay, fair enough. Implement written policies, procedures, and internal controls, including daily reconciliations against the beneficial ownership records. Again, okay, seems okay so far so good. Require an executive officer of the bank to annually certify to the FDIC and the bank's primary federal regulator that these reconciliations are being conducted. Is that now here's where I say, like, is that a little bit much? I would probably say yes. I mean, in other words, why can't they just say that it's being conducted, and then obviously um, through the audit process, you can determine if these things are being conducted or not. I don't know why the executive officer has to do an annual certification of this. That again, that seems like a little bit of overkill. So, um, but I think that the big takeaway here is that this is a big issue, and this is going to be a big issue throughout. I think most of 2025, arguing about just the fintech relationship in general, how that's managed, what banks need to do in like a crisis situation, if, like I said, if a fintech fails, whatever. I think, and again, I don't think some of this stuff is bad, is a bad idea. I mean, again, the custodial account record keeping, a lot of that would seem like it makes some sense there. Banks should do this to make sure that they're not losing track of their customers' money when dealing with the fintech. But you also got to make sure that while the bank might be doing this, you got to make sure the fintech is also doing this as well. So so some things need to be worked out in that regard. But like I said, I think throwing in I have a lot of questions about this rulemaking from the FDIC. How's that all going to play out? And then the whole broker deposits conversation. Like, I feel like that in a certain respect, I feel like that kind of got lobbed into this thing out of left field. And I think I see those as two separate issues. But I don't know. Like I said, if you're wrong, or if you think if there's something I'm missing there, put some comments in there. Throw some comments on this video. Let's have that conversation, as it were. So, but okay. And then it says here, what's next? So, enhanced scrutiny of bank fintech relationships can be expected to continue after the change of administration, as the collapse of Synapse demonstrated the need for stronger oversight by banks of third-party providers. While the new administration likely will seek more targeted rules rather than broad, ambiguous, and sweeping guidance, banks will need to continue to devote significant compliance resources to oversee and monitor their fintech relationships. Yes, I agree with that. Absolutely, I agree with that 110%. So there's more to come here. So this is, like I said, this is only the first two articles. This is a 4-part series. Like I said, I was waiting for the second article to come out. It did. So like I said, I wanted to cover these first 2 parts. I will cover the next 2 parts whenever they come out. It could take a month, could take 2 months for that to come out. And I would imagine that in that time frame that we're waiting for these next articles, these next installments in the series to come out, that we'll probably see some updates. Obviously, new administration coming in January 20th. Then we'll see kind of what happens throughout the month of February. So like I said, I would expect there to be ongoing updates to this as it goes on. But I don't expect this to be settled either. I think this will go, run throughout 2025, as we have a lot of discussion around these different items. But again, I thought these 2 articles were really good, putting a spotlight on this kind of, like I said, war on fintech, if you will, at the moment. And like I said, we'll continue to follow this and see what happens. But if you like this episode, please make sure to like, share, and subscribe, as that helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. And make sure to check out some other content on the channel. But I hope everyone has a great day. I'll see you again real soon. Thanks a lot.